Jeffery Elswick, before we talk about bonds and the Frost Total Return Fund, I want to get your view about the economy for the rest of 2015. Where do you see it going?
Sure. So for the rest of this year, we're pretty much in the mode of just don't overthink it. And what I mean by that is, for several years now, the growth in particularly the United States has been ebbing and flowing, but it's in this range of 2 to 2.5%. And our view is that essentially for 2015, we're going to see, once again, growth of somewhere between 2 and 2.5%. Obviously, in the first quarter, we had a pretty poor first quarter in the United States, but we see growth beginning to move back up, starting right now in the second quarter. And when you come right down to it, our base view is that we're going to continue to see growth in this 2 to 2.5%, not just for the rest of this year, but into 2016.
And do you think Fed Chair Janet Yellen sees it that way? What are you seeing at the Fed?
Yeah, so don't know if Janet Yellen and the rest of the FOMC sees it exactly like we do, but in our perspective, the Fed absolutely, and the FOMC definitely sees an economy that is self-sustaining, moving in the self-sustaining way. And our personal view is that we think, without a doubt, the Fed is in fact going to lift money market rates, the federal funds rate, for the first time in a decade in the second half of the year.
But we have seen rates move up. The 10-year Treasury is now at 2.4%, up from 1.8% in terms of yield in April. So where do you see it going from here, and how will you play that with regard to your portfolio?
Sure. So we think that yields, as short-term yields driven by the Fed, move up a little bit, not aggressively, but a little bit. Our core view is that the entire yield curve is going to shift up as well. And so, as an example, the 10-year Treasury, our base view is that the 10-year Treasury is going to end 2015 at some number between 2.75% to 3%. In the very short term, it's going to fight in this 2.5% to 2.6%, but eventually it's going to move up to 2.75% to 3% to finish out the year.
And with that in mind, what do you like in terms of different fixed income asset classes? Do you like govies? Do you like junk? Do you like munis? So where are you buying?
Sure. So in our Frost Total Return Bond Fund, as an example, we are using meaningful amounts of allocations to securitized products. Things like mortgage-backed securities, asset-backed securities, commercial mortgages. Commercial mortgages are one sector that we're still very upbeat on. We've been upbeat for a while, but those sectors in particular we think are going to continue to deliver us nice returns and better returns than just buying government securities that probably will deliver slightly negative returns for the rest of the year as rates move up a little bit. Also loans, we don't invest in loans outright, but we buy asset-backed securities that are backed by loans because we're a big investor in securitized products. And that's one sector where we're also buying, because in this environment where rates will go up a little bit, we like bonds with floating rate coupons that essentially should do materially better in a rising rate environment.
And then finally, which areas of the fixed income market are you avoiding?
Sure. So one area we're avoiding is agency mortgage-backed securities, Ginnie Mae's, Fannie's, and Freddie's, just because we think volatility will continue to increase a little bit throughout the year, especially as we get closer to the Fed. And so we think that with rates this low, volatility will inch up, and we believe there'll be a better time later this year or maybe sometime early 2016 to invest in agency mortgage-backed securities. So that's one sector that we're underweight in. Another sector that we're underweight is in Treasury securities. Now we have more Treasuries these days than we have in prior years to make sure we have enough liquidity to change our rate view, our rate position in the fund. But Treasuries are also a sector that we would expect to underperform a little bit in the rest of 2015.
Thanks a lot, Jeffrey.
You're welcome. Thank you.